Hello and welcome to the webinar, Exit with Impact, How to Optimize, De-risk and Prepare Projects Toward Investment Exits. This talk is designed for mainly three groups of people in the audience: for investors and corporate, for entrepreneurs, startups, as well as scale-up companies, which are those that are a little bit further ahead already. And of course, partners in the ecosystems like accelerators, investment managers, family offices, and so on. This webinar will be broadcasted live, and a replay will be made available right after the session. You can find the link in your email inbox, or you go later to youtube.com/Wittigonia. This is a shorter version of a little bit longer briefing that we have put together and are making available in the online academy. If you go to academy.wittigonia.com, you will find pretty much in the middle there a briefing center with the title Shape Growth Briefing Center. And you can enter there, you just log in, register, and then you can find later on the sessions there. After the webinar, there will be a live Q&A on Facebook. So if you go to facebook.com/shapegrowth, that's one word, shape growth, and there you can find the page, and you're welcome to ask questions, and I will be there to answer them. My name is Thomas Wittig, and I am the CEO of Wittigonia, a company based in Zurich, and we're working with clients around the globe. Not to go too much into my detail and background, you will find that, of course, on LinkedIn and other places, but just to give you a brief synopsis, I started my career mainly in the biotech area, in a combination of business and economics and marketing later on. The first startup I worked with was Microsoft in 1988, 89, approximately, when Microsoft was still a very small company. And who would have thought that this would be such a great success story over the years. Then during that time, I learned a lot about transformation and growth topics, platforms, ecosystems, and so on, which then led me to spend meanwhile, about 27 plus years in the industry, working with companies such as Microsoft, SAP, other fast-growing companies, as well as startups. And one of my favorite topics is system dynamics. I found this very useful for my leadership and daily work in operations, also in the companies, no matter what size. And this will be a topic throughout my webinar talks during the course of this year and moving forward. I'm also an investor on a very small scale. I invested in a couple of companies and, of course, found my own company. And I'm serving also as a advisor and head coach for some companies both in the corporate as well as in the innovation ecosystem. As a company, we are committed to help start the ecosystem and drive the ecosystem with a focus, let's say, on the startup and innovation sector. And here are some of the labels and initiatives that we support in 2016 and 17 also. There's also a shift towards more, let's say, impact investment-oriented ventures. The experience and engagement and expertise includes a wide variety of different companies, mainly in the high-tech sector, in software, service provision companies, etc. Now, going into the topic for today, Exit with Impact, let me give you the outline of what we are covering in this webinar on a high level, and also what the outline is for the more detailed briefing that you can find at the mentioned areas. So we talk a little bit about the investment process. We talk about timing and, what is a good strategy for starting to even think about exit strategies and talk about it. I will give you brief insight into some dynamics topics between investors and investee. We'll cover some success factors that I have crystallized doing my work with the innovators and the entrepreneurs. I will cover briefly the barriers, why it is so challenging, and expand on that a little bit, what the managers or the innovators can actually do in order to develop competencies. Then I'll walk you through the first glimpse of a case study and how to de-risk an impact innovation project, or generally an innovation project. And that is applicable both to the corporate as well as to the startup sector. And briefly, I will touch a little bit on optimization when you have a whole set of projects going on. And I conclude with a short checklist that I want to provide. Now, starting with the investment process, the focus of our discussion will be in the area of, let's say, startup and equity-based projects. So we're not talking about capital investments or investments in real estate or other areas. I'm also not touching specifically the family-owned businesses, because here we have typically a different setup and a different set of dynamics, both from the rational mind business perspective as well as some more non-rational mind movements here. So we will cover that in a different setting. The trends that we see today is clearly there's a shift towards more what we call impact investments. And it's driven by, the innovation is driven by accelerating technology. So we see many areas where we have accelerating growth and exponential adoption of new technologies in many areas, in life science, in medtech, in energy, information technology, of course, and so on. And it comes together with the social innovation. So there's also a shift towards more social-oriented impact projects. We have a new rise in entrepreneurship. And the financial markets also are helping in some way, because there's new capital available for these kind of initiatives, mainly because the financial situation dictates that people are not putting money into, let's say, bonds or other fixed income series, because the interest rates are fairly low at this point in time. And of course, we see many wealthy individuals who are opening up their let's say, wealth and portfolios to invest more in philanthropy. But having said that, the new paradigm is not only to give away money, but to really combine the forces and think about people, profit, and the planet. And what we can see is a big shift in these areas. So it's not only about making money and making a financial return. We see a shift from money to meaning, which means that both the investors, but also the entrepreneurs, are looking more for meaning and purpose within their work. And so I would call it the purpose with a profit, because purpose is good and doing great things is good, but if you can do it repeatedly again and again, it's even better. So that's why people are looking for recycling some of the investments and making sure that the projects are delivering a return. And that's our topic here today, of course. Now, the classical approach of going after an investment, it really starts with the scouting and screening effort. So the investor is looking for some properties or objects and projects to invest in, then followed by due diligence, where we take a look at under the hood what's really happening and is it a worthwhile and prudent idea to invest in such a company. Then we go into the structuring the deal phase. And then when the deal is done and signed, we are embarking on a usually very long management phase of the investment. And that's, of course, on the project level, but also on the, let's say, the investment or sometimes portfolio level. And then it's sometimes it's followed by an exit, which means that the project is being sold to another entity. Now, start with the vision in mind. So what I mean by that is to not start thinking about the exit in the 11th hour when it's 5 minutes before 12, but really to think early about it and have a conversation. And that is really the small change to the process, to start with your vision, both if you are an investor as well an entrepreneur. So what do you have in mind? And it's completely fair and okay to speak about that early on. What is the purpose? What is the strategy to get there? Only if that is aligned between the investors, the entrepreneurs, and future stakeholders, that is going to be then a fruitful exercise. And of course, the post-exit area here, illustrated by the orange chevron. The post-exit area is equally important because out of some successful projects, we see some new investors coming, some new ecosystem players. And secondly, for the investor itself who put the money into such a venture, it's not only about profit and return, but it's also about reputation. So we have to pay attention to that. Secondly, when is it a good time to think about and talk about exit strategies? That is a key question that I always get from the startups and also from the companies who are investing. Now, obviously, when you start talking about it too late and you really want to go after an exit, that usually creates a lot of friction in terms of surprises, conflicts, a last-minute scramble, and also, let's say, even some unstable situations and continuity and attrition. So sometimes, even though people talked about the exit strategy, then at some point in time, it comes a little bit as a surprise to everybody. And likewise, if you talk too early about an exit strategy, that is also harmful, because then, if you're only being perceived as thinking about an exit, or if you're an entrepreneur only thinking about an exit, that's also very challenging. I remember one of the companies I worked with, I wasn't even in the room when I first heard the word exit. And so if you think about this every day, then I think it's also a risk that you draw away your attention from your customer focus. Now, of course, starting early and inspecting the expectation along the way is the key. On the other hand, don't pull out the flowers to see how the roots are growing. What I mean by that is you don't want to go back to the business every day and check, okay, how far are we along, and are we going to have an exit anytime soon? That's of course not helpful and doesn't create a climate of trust and a climate where people, and especially the entrepreneurs, can perform and pay attention to the business. Now, in terms of safeguarding the investment projects, what we do want to make sure is that we start really early on with the alignment, vision, and goals, as I mentioned before, and that leads us to certain selection criteria of projects that fit together between the expectations between the startups and the investors, and of course potential M&A companies, M&A targets. Now, during the management phase, what we want to do is to carry the selection criteria and our assumptions and key performance indicators into these milestone reviews. I call them here M1, M2, M3, and so on. That is really important, because only then we can have a follow through and make sure that we are preparing the company, preparing the clients, preparing the processes and everything. Now, don't get me wrong. Of course, the key is, of course, to first build and run a stable, profitable business, and a business that is making an impact to whatever it is doing. But since our talk is here about exit strategies, we have to consider these factors as well, because, starting to prepare a company just, let's say, days or weeks or even months before it's supposed to be sold to an acquirer is not a good idea, for many reasons. One is the company might not be ready. The investor might be able to achieve a higher return if the company is in better shape. And it could also completely derail an acquisition altogether. So that's why it's important to have a structured milestone review, and we will cover that more and more here during this talk. Point 3, investors and investee feedback. What I have seen is it looks something like this. We have, of course, our entrepreneurs who are looking after the projects and make sure that they run the projects. On the other hand, we have the investor area here. So the investor has funds, invest the funds in a certain deal flow of projects, and the projects then ideally have an exit, and the investor is able to recycle some funds. So that's the first and primary feedback loop that we have here in the ecosystem. But also the projects themselves are creating an impact. And the better the impact and the higher it grows, the higher the willingness of the investor to release more funds into these kind of projects. That's a virtuous cycle. If the impact is unclear or unknown, then the investor is less likely to invest in new ventures of this kind. He or she might want to put the money into the bank, into other safe investments, or buy real estate. The other blue feedback loop here, which is the larger feedback loop, means that with the impact, an impact can have, of course, a favorable and unfavorable outcome, but with the increasing impact, the reputation is rising. And that, again, has an impact on the willingness to invest. Okay, so if the reputation could also be driven by the exits, of course, if there are unpleasant surprises and experiences during the exits for both sides, so that could hurt the reputation. So that's why it's really important to pay a lot of attention, because only if you have these 3 feedback loops in play, and there might be others as well, but I think these are the core ones here. Only if these feedback loops are in play, then you can really think of, let's say, a thriving impact investment. I would call these feedback loops, first of all, the green feedback loop is the investment and return. The second one is the sustained impact. And the third one is the sustained reputation, and they go together. Now, what is important is the critical link here is, of course, the project. Now, only if the projects are going well and attracting funds and delivering exit and impact, then we can think of a virtuous cycle. So that's why it is so important to pay attention on the project level in terms of project performance and project control. So that's really what we need to pay attention to, what is happening on that floor of the projects. Point 4. Factors of success and failure. What we would like to see as an investor or innovator is something like this. We are looking here, for example, at a customer base, and let's say it's an artificial example. We have 1 million potential customers in the customer base. So we are looking at this S-shaped curve usually. Surprisingly, and I will cover that later, is not many people know how it comes actually to this S-shaped curve and what is driving this. But what we are actually looking for is a rapid and accelerating adoption and accelerating growth and capturing the market share in a very quick period of time. So here in this illustration, it's just a very quick period of time. And then we hope for a lasting impact and to have the project on a really good, let's say, cruising altitude. What is often happening is something like this, that it takes much longer and we don't really capture the market to the degree that we want. And then even worse, where the project, let's say, overshoots and then declines or sometimes even collapses. So we have to ask why that is the case. And it's a fairly common picture that we see. Now, what I have seen in many projects, and we did an impact study around that, is product adoption is really the key. And of course, this hangs together with, the people and the product who are driving this adoption. Secondly, the team dynamics. And to a lesser degree, really the available funding and the technology. You could say that technology almost in no cases is really the issue. The issue is really to understand product adoption. Everything from how to access the market, how to find the first customers, how to drive word of mouth promotion, and etc. And that's where I see a real lack in these areas. Now, why is it so challenging to drive innovation projects, and particularly impact innovation projects? The project dynamics, to cover that a little bit, and now we're going a little bit more on the ground floor of where the work is happening. And let's say we have a project which has a certain idea about delivering a product to the market. So we think about a schedule and a planned completion date, and we have a certain budget. And then we would say, okay, we are moving towards that point when we can go to the market, release the product, and drive adoption. What is happening most of the time is something like this, more or less. First, there is a schedule overrun and a budget overrun. And that is very common, not only in the small projects, but of course we see it in bigger construction projects like airports, for example. So we have to ask why that is the case. Now, if we take a look at what's happening on the project level, here's a typical example. What does it take to complete this scope? Let's say our scope of the project is, in this case, it's 100 person days to complete, let's say, a product or a software platform or a community service or whatever. And then we see often that it goes in these step functions. So we have to ask why and what can we do in order to reduce this delay and the budget overrun that comes with it. And what I can say is that budgets and schedule overrun are typically a sign and not a favorable sign. So we have to pay attention to it and ask if there are the right assumptions, the right capabilities in the team. That leads me to the next topic, diving a little bit more into what I now call systemic leadership as a key competency. Now, why is that an important topic? Because we are faced with managing complexity, of course. The adoption scenarios that we sometimes use in our workshop just to test this and make an awareness can look something like this. So we have a certain number of potential customers. We have a conversion, which means that potential customers become active customers in our customer base. And I give them the participants a small example with a number of customers, initial customer base, and ask them, okay, what would happen if we have only word of mouth promotion with certain assumptions here? And not to go into detail what the real assumptions are here, but in this case that we repeated in many workshops as well as in a field study, and you can read about this on our website blog. There's a post called Hockey Stick Confessions. And so what we found was very interesting is, first of all, there was overconfidence in the earlier phases of a project. So most people would say that the adoption happens much faster as it actually would be. So in this case, we used a simulation, like we often do in working with complex systems. So we first simulate the systems according to this the structure and the feedback structure of the system. But most people don't get it right. So they say that the adoption would be much higher, actually by a factor of 6 or 8, overrated. And then later on, we asked them also, okay, if sales would have a peak, the sales volume, and they would estimate, yeah, it comes much later and we have a lot of time to go. And this is really an interesting point because they also estimate that the peak volume sales would be much higher than it actually can occur according to the feedback structure of the system here. Now, why is this important? Well, if you take a look at a lot of innovation projects, specifically also in the corporate area, we find that sometimes people miss this point. And then if you are estimating, let's say, here that your peak sales would come late, but then it's overshooting and declining, then you would need to have an innovation in place. You need to have your next generation product in place. And that's really when the panic starts and when, let's say, some unfortunate feedback loops kick in. And so that's really important to remember. So we talk about this in detail in our workshop. If you want to know more about this, there's a briefing series in the Academy The hockey stick confession link is here as well. So the academy thing that you want to look for is called Shape Growth. The course bundle, there are 3 also individual courses that you can take a look at. They are short, self-paced courses. Now, the key point here, it's an evolutionary thing. Our human brain does not cope well with complex linear systems. So we're not used to manage this as part of our day-to-day life. And this is not because we're stupid, it's because it is very complex, it's difficult to do. So we need to seek for a little bit of help here. Now, there is also good news. There's a lot of attention in the research community, in the system dynamics community and behavioral economics right now, looking at these areas. And what we found is that indeed working and shifting and advancing the mental model and understanding the system dynamics behind it, behind the situation, can improve performance of a manager significantly. Now, and in the field studies that were carried out, I believe it was around 40%. Now, is that a big number? Well, yes, of course. If I can grow 40% faster than the competition or faster than the market, then I have a much higher chance of driving adoption in the marketplace and driving success of the business model. Therefore, that leads us to another axiom here in the conclusion. Evolving the mental model is the new leadership job number 1. Think systems, and I would also add here, act as a systems leader as well. Now, how to do that? How can you increase the chances of people driving successful projects, and how can you advance the skills of system actors? First of all, what are we talking about? Let's take two perspectives here. The first one is the external perspectives. Typically, companies come to us and ask, okay, well, how can we get out of this chicken and egg problem, right? So where do we start? Because we need B2B partners or B2B customers. We need consumers for our B2C product. And we, of course, need investors and sales partners. And they could find themselves in, let's say, a fairly complex situation where they can only attract independent co-innovation partners if there's a certain customer base, because these guys would only be interested if there's already a customer base. And then once they add their products to the platform, that increases attractiveness of the platform, which drives again a virtuous cycle in adoption, which again attracts more ecosystem partners. That's how we actually bootstrap and start an ecosystem. Now, this is a smaller piece of a bigger, let's say, a model that we use for the illustration, but it illustrates the point that this is an external facing problem that the leaders and innovators are faced with. And what it leads to is something like this, and especially in the green line here illustrates some of these typical movements that we may have an initial success and then it's overshooting and collapsing for a certain reason, and then we have to scramble and run really fast to make it work again. And again, we go through this kind of rocking motion, which can be pretty stressful for an organization and an entire ecosystem. Now, the internal perspective, the second viewpoint here, is about managing the development of delivery, just as one example. You can pick other examples as well. But this is also a fairly complex undertaking, because here we have almost a spider web of different feedback loops. For example, working with customers. So the more customers I have, the more orders I get, the more staff I need, the further delivery I can provide and pre-sales I can provide to win more customers. But I also invest in product development, which drives more product adoption. Now, the question for the manager is always where and when and how to allocate resources here. And that is really the key. Now, in this particular example, which could be, let's say, an agency-based model or a service delivery model, or even an enterprise solution model, what we see is a typical behavior, something like this, where the system is oscillating, because it's very difficult to get the exact amount of resourcing right and let's say have the resources available. So the question is, what can a system thinker, system actor do differently? Now, in the briefing, I will cover that a little bit more in detail, but let's say the difference between the two scales here is, on the one hand, we have the manager who knows the who. What I mean by that is, a manager is somebody who gets things done through other people and is also good in controlling, planning, prediction, forecasting, execution. Now, the leader is the vision person, and the system thinker distinguishes herself and himself by the means of understanding feedback, accumulation, and delay. But only the system actor is really capable of understanding how to allocate the resources in the right amount of time and the right places, and designs a system that is working very effectively. That's why I think it's a step forward also to not only know about the systems, but to use this knowledge in order, for example, to kick a B2B, B2C system into gear. That is very important. Now, the question that we typically get is, how do I become such a system actor? There are two ways to do that. One is through the trial, error, and frustration approach. I call this the painful learning. And the other way to do it is through practicing it in a safe environment with the experts and a mentor, experience and apply it in the real world, get more training, and practicing what you learned again in your daily job. So I call this experiential learning, and that is what we are moving towards now. With many clients, many companies are looking into this kind of working together. And the way how we do this is, for example, we work with flight simulations. Here's an example that we like to use in our workshops. It is based on very good material from some of the leading business schools around the world. We are using here a multiplayer game about a strategic innovation challenge. Here it's a battery business. So it's a very rich environment, almost like we call this the management flight simulators. And for deep dive discussions, what I also like to do is to take a specific issue, for example, the issue of viral adoption, which most people struggle with, into some, let's say, lab setting where we take the model apart and deep dive into what is happening in different settings. So what is happening when we change the parameters. And then we look at the structure of the system to understand really what is happening and how it translates into dynamic behavior. There's a range of these models and flight simulators available that we work with in our workshops, everything from platform dynamics, innovation, even up to critical response. And this is not only relevant for, let's say, viral outbreaks, but for example, when there is a quality issue in a business or an ecosystem. During my career, I had to manage several of these situations, and even was exposed to some quality issues that required some certain activities. And what I learned from that is that it is also a very highly dynamic situation that we need to learn. So my call here is to invest in system actors, and this is a call for both the investor and corporate community, as well as people who are the innovators. It's not good enough to just have an idea about the technology and the market. One also needs to invest in yourself in order to become a system actor and system leader. Increasingly important, especially in this exponential world. The almost one of the last topics, I'd like to give you a glimpse of a high-level walkthrough of how to de-risk projects, innovation and impact projects. Now, what we would like to look for is increasing the upside opportunity and decreasing the downside opportunity. And what do we mean by that is, first of all, to understand the opportunity, to understand the risk factors that are associated with it, systematically assessing the risk and the underlying assumptions, of course. And then we look at the dynamic changes over time. And step by step, we are confirming the key assumptions, if these assumptions are right or not. And then we are surfing evidence of the social and economic return or not. could also be, right? And according to that, we would allocate stepwise the resources for moving forward. Now, that doesn't mean that we are going to spoon feed the resources into the business or the project, but we have certain major milestones where we decide about moving forward or not with a given project. Now, what that looks like, of course, is always in the context of the picture that I showed earlier, when we are walking through these milestones, M1, 2, 3, 4, however you want to define that. But it's really important to have a periodic discussion and review around the specifics here. Now, for example, the whole discussion could start with something like this. You're presenting a business model which has a certain profit and loss profile, and there's an expectation that it produces an EBITDA margin or EBIT margin of 22%. Now, the starting point is to ask, okay, what is driving this? And then we do a simulation which produces something like this. So this is the investment profile in terms of EBIT margin of a given project. And we see, here's the zero, that below the zero, there's already some cases or potential outcomes, as we call them, where the profit could be in danger, so it could produce a loss. So we have to ask why that is the case. Now, to cut it short, there's a little bit more elaboration on this in the briefing series that is coming out. But in this case, what we would do is, of course, to eliminate this chunk of the curve here. So to eliminate the potential outcomes and ask the question, how can we do that so that we have a better position, a stronger position, and we can drive for higher EBIT margins. Now, in this particular case, what we are looking at is the probability of a loss has been reduced by a factor of 13. So after the exercise, we are looking at probability of only 2.5%. So most of our potential outcomes in the future would produce a profit for the business. That is really important. And not only that, but we also have moved the mean or the average expectation of the project from 2% to 28%. So that's an important exercise to do. And that's what we mean by increasing the upside and decreasing the downside risk, of course. Now, why is this important? Mainly because performance should drive resource allocation and nothing else. When we have a situation where we're not really sure, it's okay, could it go ahead? It's kind of 50-50, or let's say there's a high risk associated with an investment, then we should not go forward with the funding easily. We should request further, let's say, rework on the project. But if we have a high confidence and we are prepared to take a risk that a certain percentage of our potential outcomes here, certain potential is associated to risk, let's say 10, 20, or 30%, whatever your favor is, then we should, of course, go forward and allocate the funding. Now, this is an approach which uses an iterative process and an effect-based process, of course, effect-based and decision-based process, so in order to make informed decisions. Now, by concluding, before I go to the checklist, what would we do if we, of course, have a situation where we have several initiatives going on, and let's say several growth initiatives or efficiency gains or developing a new product? Then, of course, we take a step forward, and we have to manage a portfolio of different projects. And that's what I always would ask during the reviews with the stakeholders. What are the projects that we have in place in order to close the performance gap between where we are today and where we need to be? So that's a framework that we like to use, and it's usually very helpful. There's more to read about this, and if you like, there's a little bit more of a presentation or a paper about sensitivity and risk analysis, which we are happy to share with interested parties. Now, coming to the checklist, Again, we'll make that available in the briefing center. But first of all, keep in mind that project selection is key. So it's not about, let's say, spreading the wealth, the money, and the energy, also the life energy into different projects, but really to purposefully select the projects which have a high potential and a high chance to move forward. Secondly, invest in system actors and advance the system leadership skills. And this is a call for the investor and the investee as well. And the investor should demand it from the investee organization. Start with the exit dialogue from the beginning or early on, and be really clear about what you mean and what the core beliefs are that you share. And if it's changing over time, that's also fair to say and articulate. Now, it's important to ensure a learning culture. It's not very helpful when the investors are breathing down the neck of the project managers every day, but really to encourage also what I call smart fails. So when you try new things, you make informed decisions, and it may or may not work out, but at least you're learning something from it, and you share that openly within the stakeholder team. Agree on the milestone reviews early on in the investment contract. Typically, it's in the shareholder agreement or share purchase agreement, wherever you want to put that. And start inspecting the expectation early. So schedule systematic and regular milestone reviews, allocate the funds stepwise according to performance. So that is important. By what we mean by performance is meeting the milestones and the key performance indicators of business and impact, of course. De-risk the project systematically. There is really almost no project that doesn't have any risk associated to it, so it would be prudent to bring that to the surface. And plan for some smart interventions with new mental models, and first of all, simulate them before what would happen, and then apply them in a small scale, and then roll them out if they're working very well. And finally, train the team on speaking to clients and M&A partners with confidence and trust about what they are doing. Now, do you need any help with that? I guess most people do. So if you want to have a review partner for your projects, or a second opinion, or some training or coaching for your teams or entities, I'd be happy to provide that. And let's talk about this. What we do is working with particularly this community of investors and corporate clients as well, and entrepreneurs and ecosystem partners on these kind of topics. There's a range of, let's say, advisory angles that we can take. It's always about innovation and growth and transformation from business, but also specifically from a people and organizational capability perspective. And as I mentioned before, there's a range of leadership trainings available. These are great in order to work together and learn something together in a safe environment before going out into the market, and even before spending precious money and time on it. And of course, we have a range of business workshops that we use in order to troubleshoot, plan, or drive a business moving forward, even up to products and service development. So would be happy to speak with you. Here's our contact information. Simply send email to info@wittigonia.net, or give us a call. You can find the information on wittigonia.com. And I would like to open for a Q&A. Before I do that, I should mention that, again, the replay of the session will be available on the YouTube channel of Wittigonia. If you just Google Wittigonia in YouTube, you'll find it. And the detailed version of the briefing you can find in our online academy, as I mentioned before, in the free of charge briefing center called Shape Growth. So there you can find a detailed version of that. Now, back to the Q&A. I see some questions were submitted here in the webinar room. A first question is, are there cultural differences between this, and how do you work with a multicultural team? What I have seen is that there are, of course, cultural differences in the way how people work with each other and how they advance their working relationships with each other. But in pretty much every case, we see that people are open to this kind of approach and are actually leaning towards it because it gives them a ground of having a more effective discussion and conversation, and also holding each other and themselves accountable for the outcomes. So I think that is applicable in many also distributed or very diverse settings here. Then we have another question of Pierre, I believe that is. Have you done this in the ICT sector? Yes, of course, this is main focus area for us, for me personally, actually, also given my background. So we have worked with a couple of clients in this area on fairly large projects where we pursue a similar approach, sometimes more or less explicitly than we show it here. Sometimes it can be fairly elaborate. It depends really on the situation of the client. Where can I learn more about this? Well, just go to our homepage or academywittigonia.com. There you will find some more. Yes, so I think there's some more questions coming in. As I mentioned before, we will do the Q&A on Facebook. So if you go to, Shape Growth, find Shape Growth in facebook.com, there is a website where I'm taking some live questions, those that haven't been covered here or that we don't cover offline. So feel free also to leave a comment there. And if you're missing something, just send us email or ask for it in the Shape Growth group. Having said that, I want to thank you for your participation and attention. It was great also when we started this series to get some very encouraging feedback. It seems that we are onto something here. And I would very much welcome you to future webinar sessions. Now, this same webinar will be made available for live participation in the next couple of weeks. We will share the content on the properties, as I mentioned before. But there are also other live webinars that are happening in parallel right now. One is about how to prepare and present pitches. And so I would encourage you to check out our website to see what we have going on. So thanks again, and good luck in shaping the growth of your business. Looking forward to see you. Goodbye.